Yes, there's a potential for a market crash, but if you understand the market cycle and you understand what the market is going through, you'll be able to ease your mind just looking at this video. Hello everyone, welcome to Just Invest Today, and in today's video we're going to talk about the market cycle, what's happening in the market, and is there a potential for a market crash? What is going on? Because I see a lot of people just like irritated. People are talking about a market crash and what's happening in the market, but we have to understand the market cycle, what's happening in the news and what's going on. As the Fed keeps talking about inflation, probably maybe interest rates going up or maybe not going up, or whatever's happening with the news regarding the Federal Reserve, it's all interesting. It's all affecting the market, and this is all a part of the market cycle. So we're going to get into it in this video. We're going to talk about Joel Greenblatt and what he thinks about it, Peter Lynch, and what we're seeing, guys. But please, before this, can you please like this video, subscribe to my channel? I'm going to be providing you with so much new content, man. So please like and subscribe. Come on, click it, click it, click it. Thank you so much. So we understand there's like a little crash going on in the market. The Russell has been getting killed. All the small and medium cap stocks have been getting killed. Even the companies that succeeded during the whole pandemic are getting crushed in 2021. 2020, look at the gains of all of these companies. And then in 2021, look at the return now. They dropped in 72%, 75, 45, 64, 54, 35%. So look at all these companies: Peloton, Zoom, Pinduoduo, Fastly, DraftKings, Quantum Escape, Pinterest, Blog, Twilio. All of these companies have been dropping like a rock, because you got to think about it. When situations like this come up with the Federal Reserve and how they're thinking about the market and inflation, people are running to the S&P 500 to get some security. People are afraid of losing their money due to inflation. So that's creating this whole crash scenario and a potential for a crash. People are fleeing. People are running away. They're putting their money in Apple, Microsoft, Facebook, all of these solid companies that can survive a market crash, because people think that's a secure bet because of inflation. They don't want to lose their money. So just look at what's driving the gains of the S&P 500. People are like, what? The market is up 26%? How is that possible? Because everyone's putting their money in like a safe bet in their mind. So 5 giant stocks are driving the S&P 500 to records. But if you really look at the market, it doesn't feel that way. But this is the case. Goldman's research shows that 5 stocks have accounted for 51% of the S&P 500's return since the end of April. Those 5 stocks are Microsoft, Google, Apple, Nvidia, Tesla. They account for more than 1/3 of the S&P 500's 26% return this year. How many people do you think are making 26% this year? I feel like if you're not invested in those top 5 stocks, you are probably getting killed in the market right now, honestly. But we have to understand the market cycle and how to recover from this. So if you're not in these stocks right now, like Microsoft, Apple, Amazon, Tesla, Google, Facebook, Nvidia, Berkshire, man, you might be losing out. You might be getting crushed in the market right now. But look what Joel Greenblatt said, and you have to understand that if you did your valuation work fine, the companies that you own are gonna recover, man, and that's what you really gotta think about. The market is just random right now. The Mr. Market just goes through its cycles of pessimism, optimism, all of that stuff, and you do not have to actually take that information in and like go out in the market and like use it right away. You can just sit back, relax, and just enjoy the ride. So look what Joel Greenblatt says about the market cycle and what happens.
You've had a nice record, but now there are more computers, there's more data, there's more ability to crunch numbers, and kind of isn't the party over for us? Isn't it just more hedge funds? There's just a lot more competition. Isn't the party over for us?
And that's what a lot of people think. A lot of people think that like, oh, did we miss out on the boat because the market is all these all-time highs? Man, the market is never going to go down, etc., etc. But guys, there's always opportunities in the market, especially during a market cycle like this.
My students are generally second-year MBAs. I'd say average age 27 or so. So I just answer it this way. I tell them, let's go back to when you learned how to read. Let's take a look at the most followed market in the world. That would be the United States. Let's take a look at the most followed stocks within the most followed market in the world. Those would be the S&P 500 stocks. Let's take a look at what's happened since you learned how to read. So I tell them from 1997, when they were 9 or 10, to 2000, the S&P 500 doubled. From 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. And from 2009 to today, it's roughly tripled. Which is my way of telling them that people are still crazy.
And see, that's what I'm trying to say. The emotions of the market run the market. You see all that halving and doubling, that's all emotions, and that's where you have to take advantage of the market. So if the market right now, and if you see companies that you're willing to buy because the market is giving you that opportunity, you need to take it. The market is just going through those rough patches of just up and down and up and down. And this is going to happen all the time as people get worried, people get fearful, and then when people get enthusiasm and all that stuff, that's what's going to happen. The market is going to go through these market cycles, and a potential crash can happen when the market is this emotional. Peter Lynch ran his fund from 1977 to 1990, and he says in 13 years of running the fund, 9 to 10 times the market went down 10%, his fund went down 10%. So if you're going to be in the market, you have to have that long-term time horizon of thinking about, if I'm going to invest my money, I'm going to have to look at it in like a 2, 3, 5 year span. Like, you shouldn't have to worry about that money in like 5 years if you're really going to invest your money.
That was just the last 17 years. And I'm way understating the case. Because the S&P 500 is an average of 500 stocks. If you lift up the covers and look underneath what's going on, there's huge dispersion of those 500 stocks between those at any particular time that are in favor and those that are out of favor. And so there's a wild ride going underneath the covers. If you look under the covers, there's a wild ride of those 500 stocks at any particular time, and that doubling and halving.
And when you think about that, you have to understand that, like, all the companies in the S&P 500, there's 500. All of these top companies are majority of the market making all the profit. But when you go deeper and deeper, all of these companies aren't doing the same thing that the top Apples, the Facebooks, all of those strong companies making all these market gains aren't doing the same thing as every other company. So there's always advantages of looking into the S&P 500 and probably seeing what's undervalued, because there's going to be gyrations in what's happening in those companies.
With the average of 500 stocks really smoothing the ride. So there should be an opportunity. And if you understand what stocks are, and I guarantee my students first day of class, I make a guarantee every year. They walk in and I guarantee them this: if they do good valuation work of a company, I guarantee them the market will agree with them. I just never tell them when. Could be a couple of weeks, could be 2 or 3 years, but if they do good valuation work, the market will agree with them. Stocks are not pieces of paper that bounce up and down and you put complicated ratios on, like Sharpe ratios or Sortino ratios. Stocks are ownership shares of businesses.
That's it for the Joel Greenblatt segment, and I'm going to go into some quotes by Peter Lynch because they're so crucial during this time. It makes you really think of what's happening, man. So if you bought undervalued companies, you bought solid companies that you understand, you know that they're going to be successful going forward, you don't have to worry about the market cycle. No one can predict the market. Don't listen to predictions. You have to understand the market goes down. There has been 95 years this century where we had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. Once every 2 years, the market falls 10%. Once every 6 years, it falls 25%. These are the big drops. This is the nature of the market. That's the nature of the market. The market is going to go through that struggle of up and down, and that's just how it is. So you have to be able to accept that if you want to be a deep value investor and stay long-term focused in this market. So there is a potential for a crash, but the crash should not worry you at all if you were a long-term investor in this market, man. So that's it for your video, guys. Can you please like it, subscribe to my channel, and I'll get back to you in the next video. Peace!